Ladies and gentlemen, thank you for joining this Payden Regal update. Joining me from Payden, I have Brian Matthews, Managing Principal and CFO. Brian has been with Payden and Regal for some 34 plus years now, joining Payden back in 1986. Brian, great to have you on the call.
Thank you, Steve. Great to be on the call.
Brian, the format today is a fairly short Q&A session designed as a way of providing an update to our Payden clients here in Australia. So perhaps a good place to start is with a quick recap of the early phase of the COVID-19 crisis back in March. As we know, the health crisis quickly evolved into a financial crisis as governments began shutting down entire economies. What price action did you witness across fixed income markets during this acute phase of the global market sell-off? And how did you approach interpreting the extreme price action between liquidity-driven pricing as distinct from genuine credit quality decline and market repricing the risk of impairment?
Thanks, Steve. Well, that's a lot to unpack, but let me first begin by saying best wishes to all of our shareholders in the fund. I hope and trust all are well. This has been a challenging episode, I think, for all of us, and I'm happy to report that our firm, that we continue to be all healthy, working well, working from home, but very successfully on your behalf. So Steve, let me sort of start with a little recap. It was quite an unusual period of time, which is really a great understatement. I've been in this business almost 40 years now. Scott Weiner, who joins me as the founding portfolio manager and the strategy at Payden, has been in the markets about as long. So you've got people with about 75 years of experience combined, and we've never seen anything like this. And there really hasn't been anything like this. And simply, it was because we had, by government fiat, a global shutdown of world economies where about 90% of world economies were pretty much turned off by a light switch. That's not something that in my career or in our thinking of how we look at risk that we would ever model or contemplate. And therefore, it did come as a surprise. But this is where having a philosophy in place and a discipline in place can even help you get through unexpected moments like the COVID crisis in March. So let me begin by saying it was interesting to watch how the fund was performing, because through February, we were actually up, I think about a little over 1.5%, and we're doing quite well when we started seeing the markets reacting to what was then it seemed like more like an Asian epidemic and more isolated, and we're seeing how it was having some early impacts on the market. We were taking some steps to get more defensive. In a portfolio that was already well structured and rather defensive with ample cash, we were looking to see where those parts of the sectors might be impacted by if this were to go further. For example, travel, airlines, hotels, shipping, things like that, cruise lines, and trying to get a sense of what else might be impacted if this were to get to be a wider phenomenon, and how can we protect the portfolio while there was still an opportunity to do so, which is what we did. Now, let me tell you quickly, things turned south. In the first week of March, actually the second week of March, as I recall, we even left our firm on March 17th to start working from home, as did most of the nation at that point in time. It was, even in the middle of March, the performance of our portfolio was still doing better than traditional high yield and other types of traditional credit portfolios. So we were feeling pretty good that, you know what, the good diversification we have in our portfolio, from corporate bonds to securitized bonds to government bonds around the globe, that was paying off and actually was providing some good diversity. We were actually doing okay relative to the broader indices. Something interesting happened that I've never seen in my career in the second or third week of March now, where we were all working from home. So imagine I'm trying to do trading as everybody's now for the first time working in this new environment. You already have the stress that produces, people dislocated from their management teams, and then trying to sell anything in a market like that, you can imagine how difficult that might be. So it's not something you wanted to sell into unless you had to. We did not. As I said, we were well positioned with cash. However, there were a couple of large real estate hedge funds that were highly levered, and they were getting margin calls. And because of that, and because they didn't have liquid securities in the core of their portfolio, they had to sell the only cash-like instruments they owned. And these were some residential mortgage-backed securities here in the US, similar securities to what we had in our portfolio that were very good credit qualities, securities that had actually performed very well in the market sell-off of the fourth quarter of 2018. So imagine you have a forced seller of volume, no real buying appetite, no two-way trading. So there's really no price discovery. You had a distressed situation that caused prices to drop precipitously, where bonds, those bonds that had been priced near par 1 week earlier, now were being bid at 60 points, 60 cents on the dollar. So that was really quite dramatic. Now, we also saw some other interesting things, Steve. We saw US Treasuries, the world's largest, most liquid bond market, where we saw bid offer spreads on 30-year Treasuries 100 basis points. That's phenomenal. Normally they trade within a couple of basis points between bid offer. Another example of extraordinary. In the CLO markets, a form of a structured leveraged loan type of instrument, AAA tranches, these are really very strong, high quality, very liquid. We saw these being sold at spreads greater than AA and even single A tranches. These are AAA tranches which have never taken a loss in the entire history of CLO. So this is the cream of the crop, and yet we watch them trade at wider than AA. And why would that be? Well, again, when you have to create liquidity because you're in a stress situation and you have a margin call, you sell those things where you're likely to get any bid, not the best bid, but a bid. And that's why the best things were being sold at really bad prices. So then think about how this plays through the system. We're a bond market, which means our securities are not traded on a listed exchange. So the only price discovery is through actual transactions. And then because there are literally tens of thousands of different types of bonds around the world, the pricing services can only look at actual trades, and then they have to, through a matrix price system, kind of guess at what the prices would be for comparable securities or credit ratings. It's a guesswork at that point. So you took a lack of transparency and visibility in the middle of March in this COVID-induced crisis, forced sellers of a handful of securities, matrix pricing to try to at least put some prices on there, and we watched a breathtaking decline in the NAV, the drawdown. I would really relate that in my career to seeing that as just really an air pocket. You didn't really have true price discovery like we did in the great financial crisis, where you could truly see buyers and sellers coming together and establishing a price based on credit and liquidity. There was no real two-way action here. So again, with very few data points, we were watching everything being marked down. Now, the validation of this, I think, occurs very shortly thereafter, because even as big as the drawdown was, within 2 weeks, we saw some material recovery in that drawdown as some real trading started taking place. And in fact, we, on behalf of the GIO fund, were out trying to take advantage of buying some of these very same securities that we liked a lot. We had done a lot of work underwriting and felt if we can get them at these prices, we're going to grab them. Well, here's another point, Steve. If this was a true price market, we should have been able to buy some of these very depressed bonds at prices near where they were being marked in our portfolios. We couldn't find many bonds at all. And when we did, they were often 15 to 20 points higher than where they were marked, meaning we'd have to pay 15 or 20 points more than where they're being priced in the portfolio. That's a very clear indication that this was not a reflection of the credit impairment or a worry about risk of capital. This is just simply a lack of true trading and liquidity. So quite extraordinary. But fortunately, we saw some resumption of a little bit of normalcy as we started seeing the response of both our central banks around the world, particularly in the US, and also fiscal policy. So again, a lot of things that were upside down, things you couldn't model for. But I will tell you this, Steve, at the end of the day, because we don't always have a crystal ball to see how things could play out, and you always have to expect the unexpected, what we always fall back on in this portfolio and other portfolios we run at the firm is good credit underwriting, making sure that these rather short maturity bonds are going to be paid back at maturity, even in a very difficult economic scenario. And that's what we pin our underlying, that's our best risk management, frankly, not the modeling, not what's happened in the past, but these are good bonds that we can weather a storm and get paid back at maturity. So hopefully that, you had a big question. Hopefully that kind of addressed it. Steve, did I catch everything?
You're right, Brian. It was a big question, and I think you got everything. So thank you for that. So as you just described, given the subsequent dire situation in markets, and also you mentioned we saw monetary policy response from government central banks and a fiscal policy response from governments. I think that was widely described as unconventional. It was incredibly large and was well targeted. as the policy responses began making their way into the financial system and the real economy, where did you begin seeing a stabilising impact within fixed income markets? And what action did you take to position the portfolio to benefit from the improvement in price discovery?
Right. So, Steve, this is a situation where the institutions got it right. When I talk about institutions, I'm talking about central banks and fiscal policy, monetary and fiscal policy. If you remember in the great financial crisis, it took a long time, particularly here in the US, where we were the epicenter of that crisis. It took a long time for the central bank to respond, and it took even longer for a fiscal response. They've learned their lessons from that, and they realized that delay cost a lot of job loss. It cost a lot of longer term suffering. And they knew that because, now this is very important, because it was a government mandate to shut down the economy, the government felt particularly sensitive to the fact that they needed to also support it. This was not like the bad actors of the GFC, where you really needed to flush out the levered housing, mortgage borrowing, all of that needed to be flushed out because it was irresponsible. This was a situation where nobody had done anything wrong. We were attacked by this unseen virus, and therefore, let's all go home, stop work. And the government said, well, now we have to provide support to that. So fortunately, central bank, our US central bank particularly, stepped in and literally expanded its balance sheet, trillions of dollars. And in fact, if you look at global central banks around the world, it was 5, 6, 7 trillion in expansion of balance sheets. That had an immediate effect because doing that signaled to the market, the Fed understood the need to provide liquidity because, to my earlier comments, the plumbing was clogged. There was no real trading. There was no price discovery, and things were when liquidity had to be provided for distressed sellers, they were really at distressed prices. So the Fed said, we got to get in there, unclog the plumbing. So what did they do? Launched a whole number of programs, including the prospect of supporting the investment grade credit market, as well as the high yield bond market, and a variety of other things in the highest quality structured securities, something called TALF. So all these different policies came out one after the other. We saw an immediate response and sort of a shot of octane into the credit markets where prices started rallying on that. And then we saw some people like ourselves trying to get into the market to buy some of these bonds and take advantage of the now provided liquidity as well as really still attractive pricing. So to be specific, as I mentioned earlier, we were already looking for what we call matchers. Matchers mean trying to buy more of something we already have in the portfolio, something that matches a holding. And why we like that is we've already done the hard work. We know why we have it in the portfolio. We've done the credit work. We've underwritten it, if you will, or reanalyzed it now with the lens, a new lens of a COVID recession. What does that look like? We really like the holdings and the robust nature of these securities in terms of their likelihood to repay full. And we wanted to add to them. So we started looking at different types of securitized bonds. We also looked at some high yield bonds that we could pick up cheaply. Something else that was interesting, there was a lot of new investment grade bond issuance based on the response to the Fed providing support to the investment grade corporate bond market. So we saw an historic amount of new issue volume by MasterCard and Nike and American Express and these really gold chip companies, blue chip companies rather, that were just trying to get cash because since there was a lot of unknown, they thought this is a good time to go out and simply build up their balance sheets. And we were able, therefore, to get really solid names in the new issue market at concessions, which means a discount to existing similar securities in the marketplace of 100 to 200 basis points in yield, so 1 to 2 percentage points. That's attractive. So that was low-hanging fruit to us. We went in and took advantage of that for the fund and bought up as much of these new issue investment grade credit bonds as we could, that in fact have performed well, many of which now have rallied 10, 12, 13 points in that ensuing time. And currently we're now unwinding that. We've really gotten all the value out of that, and we're starting to take that out of the portfolio and just crystallize those gains. So again, there was also a fiscal response, unprecedented amount of money, $2 trillion. That really helped the consumer, and that really gave a lot of visibility as to how we were going to weather this more protracted COVID-induced shutdown of the economy. And that, I think that gave us some clarity about how to reconsider sort of the winners and losers in the various credit markets and reassess our current holdings and look where we wanted to continue to add to the portfolio. So we definitely took advantage of the opportunity.
Okay, terrific. Well, turning now to the outlook for fixed income more broadly. Investors have traditionally looked to the fixed income allocations of their portfolios for a defensive, lower volatility return with some consistent income. Following what has been historically a volatile period for fixed income, do you think investors can reasonably expect to achieve these investment outcomes going forward, given today's very low interest rate environment globally?
So it is exactly the right question to ask, Steve, because this is the challenge. Traditionally fixed income is supposed to be that anchor to maybe higher beta parts of your portfolio like equity. And in a flight to quality and a risk off market, that's typically what you would see. And in fact, we saw that here too, but it's only going to be true with government bonds for the most part. And historically, if you look, when you really want to protect your portfolio against a risk off moment in time, corporate bonds are obviously going to be correlated to what's happening in the broader markets in terms of risk. So the higher quality ones, their spreads might widen, but they're still going to probably see price appreciation because they're still going to follow treasuries. And generally, the yield move overcomes the spread widening. There's a lot of math and all that, but the bottom line is you get some pretty good protection from that. As you start moving down in quality and get into high yield bonds, they're going to behave a lot more like equity. And so you're going to find negative performance like you would in the broader equity market. So for shorter periods of time, you're going to see more of a short-term correlation where your bonds aren't doing as much in terms of protecting unless they tend to be government bonds. Here's the problem, as we all know. Government bonds globally are in most of the world now near zero, and in large parts of the world negative. So it's a tough prospect to get excited about buying those bonds when you're yielding either negatively or very near zero. And additionally, from an historic perspective, yes, rates can go negative. We've seen that in Europe and other parts of the world, but they shouldn't stay negative for long. It's got a very deleterious effect. And so if you're looking much longer term, which we should as investors, I don't think I would want to own a long duration bond, 10 to 30 years, earning 70, 80 basis points in Australia, for example, 60 in the US, and then negative 50 basis points in Germany. I wouldn't want to own those because I expect at some point we will emerge from this. Inflation will rise in the future, and these bonds will therefore, the yields will rise again, and you're sitting with almost near zero or negative yielding bonds. That's not going to be a good outcome. So I wouldn't want to own long duration bonds. And this is exactly why we're seeing a lot of interest in the types of strategies like we are providing the GIO fund, which is a very short maturity strategy that still takes advantage of credit. So we know we're going to have some of that correlated risk, but because they're short maturity by design, if we're buying 3 and 4 year maturities as opposed to 30-year bonds, and if we can get a 2 to 3% yield, that's a very attractive income to harvest. While if rates go up and these things happen, we're going to have those bonds mature within a couple of years. So that's okay. We can reinvest it now, those higher rates, or the price will be less volatile because they're very short maturity bonds. We call this the pull to par because we're going to get that money back at par over a shorter time frame than a traditional bond portfolio. So again, yes, we think that bonds play a role, but they play a different role than maybe they had historically. This is where a shorter maturity profile with really good quality credits getting additional income is the smart way, we think, to play fixed income. And that's what this strategy is, and that's where we're seeing a lot of interest.
Okay, so Brian, with that in mind, and look, you've touched on this already, but just having a closer look at the Payden Global Income Opportunities Fund, I mean, what are your forward return expectations for the fund? You've spoken about this briefly already, but where are you seeing attractive risk-adjusted opportunities across fixed income markets globally? And how is the fund positioned to take advantage of these opportunities and deliver the return outcomes investors are seeking?
Steve, the always dangerous and risky question: where do we see performance going forward? You know what? There's one easy answer. In fixed income, you always start with the yield to maturity. That's the one thing you know. So we have a series of bonds in this portfolio. We know what their yield to maturity is. We know that the average duration of this portfolio is a little less than 2 years. So you have a sense of, is this 10 years or 30 years? No, it's pretty short maturity profile. And so we know the portfolio is yielding over 3% right now. So that's a good starting point. So all things being equal, over the next 12 months, we'd expect to earn something around 3% or more. Still very attractive when you look at bank bill swaps or any type of cash equivalents in Australia right now. That's a very healthy yield. We also have, on average, the average price of the securities in the portfolio are less than par. They're 97-ish. And so when you consider that we have that pull to par, we would expect to see that also generate some additional performance as these bonds mature and get close to their maturity. So it was funny. I was asked this question in March, April, when the drawdown was near its greatest, and I said, I really feel pretty good that we're going to get back to even by year end, which is quite a statement then if you think about it. And here we are in July, and we're almost back. We have a little ways to go, but we're close to even now. We've really regained quite a bit of that drawdown with a good, healthy yield. So I feel pretty good. My colleagues and I feel pretty good about that powerful income and the quality of the underwritten securities in the portfolio. Now, let me be clear. This is not going to be a linear recovery. We've already seen a resurgence of COVID in parts of the world, particularly here in the US. That's having an effect of having people, again, having to slow down on this, get back to work. But we also are seeing some very bright shoots in terms of where we have a thematic position here. Housing starts in the US, both existing and new home sales in the US, are really, really robust. There's good demand for housing, and the strength of the consumer to support that market, particularly the ones that we've chosen to face, if you will. In other words, the ones that are underwritten by our big agencies, Fannie Mae and Freddie Mac, they tend to underwrite the higher credit borrowers, those who most likely still have their jobs now. So, and with a lot of home price appreciation. On top of that, even in the midst of all this uncertainty, we're seeing really good signs of a robust strength in the housing market. That's all good for us. So, again, we don't think it's going to be a linear recovery. There's going to be some bumps along the way, but here's what we've done. We've taken some chips off the table. We've had a good recovery so far. So we've taken some of the things that we think have probably come back as much as they're going to at this point. We've built up some cash, and we're waiting patiently for some more volatility, which we certainly expect in the coming quarters, because we would like to buy some more of our securities at better pricing than we currently have. So again, we're playing the long game here. But in the meanwhile, we've got a nice running yield, which should be helpful. And we have some pull to par to help get that pricing up with a short maturity profile. So have a pretty cautiously optimistic view going forward.
Okay, and finally, Brian, just as a way of wrapping up the Q&A today, would you like to make any final comments in the context of our discussion?
Thanks, Steve. I appreciate that. I think the most important thing, when you really distill this down, as a firm, we manage about 185 billion Aussie dollars under management globally. It's a lot of money, but the one thing that always is our sort of our North Star, if you will, is it's the good credit selection. It's the good underwriting. We don't chase yield. We don't chase things because they're cheap. We really take the time and effort to look at the securities, the structure of the securities, the credit worthiness, and buy security by security, and not just simply make an asset allocation into high yield or emerging market or government bonds. It's really a sort of a bond picker's portfolio. And we've got a great team that support that. And why I mention that is because we've got all the modeling that you would expect to do modeling and determine, the current portfolio, how might it behave in a difficult environment. At the end of the day, those things really don't serve your purposes because you can be lulled into a false sense of complacency. It's actually these models that I think caused and contributed greatly to the GFC. Too many people are relying on models to tell them they could take on more risk at exactly the wrong time. We don't do that. The models we certainly look at to make sure that they're confirming what we should know as seasoned portfolio managers who actually know every bond in the portfolio and why we own it. So that's an important part of the process. But because we take, I think, that extra care to really feel confident in each individual security, that's our best risk management, because we don't know what the next turn might look like. And this is a great example. We never could have foreseen, nobody could have foreseen what took place in the last few months. But the good news is because we took the time and effort before and always looking at the underlying securities and feel that these are bonds that could really weather a lot of different unexpected scenarios, that's your best risk management. And I think this portfolio and all of our short portfolios at the firm have demonstrated exactly that type of resilience. And they've recovered very nicely, and they have a nice running yield. And we've done this without any impairment. So this is not about bad credit selection or credit impairment. This is about a liquidity air pocket, is probably a term I like to use, and a nice strong recovery and a nice attractive running yield. And we're looking for more opportunities to add to it. But again, it's going to be a very practical approach to how we look at the portfolio and what we choose to buy or sell in the portfolio.
Well, Brian, look, thanks very much for joining me today on the call and sharing your insights.
Thank you, Steve, and thanks to all the investors.
Ladies and gentlemen, thank you for listening, and I hope you found this of value. On behalf of GSFM and Payden Regal, thank you for your ongoing support, and we look forward to providing you with another update very soon. Thank you.